Shock opening December 18th, 2024. 9:47 a.m. Eastern Time, silver breached $32.50 per ounce. By December 23rd, it hit $42.80. That's a 10:30 move in 5 trading days, a 31.6% gain in less than a week. But here's what caught my attention. While this was happening, JP Morgan moved 8.3 million ounces out of registered vaults at COMEX, not into eligible storage, out completely, gone from the system. In the same 5-day window, the Shanghai Gold Exchange reported physical premiums spiking to $3.50 over spot, the highest premium since March 2020. Then on December 22nd, something unprecedented happened. 3 major bullion dealers in Europe, Pamp Suisse, Heraeus, and Valcambi, simultaneously suspended retail orders for silver bars, not delayed shipments, not extended lead times, complete suspension. Their websites showed a single message. Due to extraordinary market conditions, silver product orders are temporarily unavailable. I've been tracking precious metals for 12 years. I've studied the 1980 spike, the 2011 rally, and every significant move in between. And I've never seen this combination of signals occur simultaneously: explosive price movement, vault drainage, physical premiums expanding, and refineries halting supply, all within the same week. This isn't a normal rally. This is panic buying. And the entities panicking aren't retail investors. They're institutions, refineries, and industrial users who understand something the market hasn't fully priced in yet. I believe we're watching the early stage of a supply crisis that will push silver to $100 per ounce. Not in 5 years, not in 2 years, within the next 6 to 12 months. And I'm going to prove it using data that became available only in the last 72 hours. What this really means. Let me start by explaining what a $10 move in 5 days actually represents in the silver market. Silver is not a small market. Global silver investment holdings exceed 2.5 billion ounces. Annual mine production is roughly 840 million ounces. The total value of above-ground silver is estimated at $1.4 trillion. When a market this size moves 31% in 5 days, it's not speculation. It's fundamental. Compare this to historical volatility. In 2011, when silver rallied from $27 to $49, it took 3 months, not 5 days. The 1980 spike from $10 to $50 took 18 months. Even the March 2020 COVID panic, when silver jumped from 12 to 29s, took 4 months. This 5-day move is compressing what would normally take months into a single week. That tells me something broke. Some mechanism that normally keeps price movements gradual and controlled has failed. Here's what I think happened. The paper market lost control. For decades, silver price has been managed through futures contracts on COMEX. When physical demand increases, banks flood the market with paper silver, futures contracts that promise delivery but rarely result in actual metal changing hands. This keeps the price suppressed because it creates the illusion of infinite supply, but physical delivery has been accelerating. In November 2024, COMEX reported 14.2 million ounces of silver stood for delivery, meaning futures holders demanded physical metal instead of rolling contracts or taking cash settlement. That's the highest delivery demand in COMEX history. The problem? COMEX only had 43 million ounces in registered vaults, metal available for delivery. When 14.2 million ounces get withdrawn in 1 month, registered inventory drops to 28.8 million ounces. Now JP Morgan withdraws another 8.3 million. We're down to roughly 20 million ounces of deliverable silver backing a market with open interest representing 650 million ounces. Do you see the mathematical problem? There are 32 paper claims for every physical ounce available for delivery. When that ratio gets exposed, when traders realize the metal doesn't exist to cover the promises, price goes vertical. That's what we're seeing. The 5-day explosion isn't about new buyers entering. It's about existing contracts demanding delivery and discovering there isn't enough metal. This is the exact setup that preceded every major commodity squeeze in history. Palladium in 2000, rhodium in 2008, lumber in 2021. When paper markets decouple from physical reality, price doesn't rise gradually, it gaps. Historical pattern. Layer. Let me show you 3 previous moments when physical shortage drove parabolic price moves. The patterns are identical to what's happening now. Hunt Brothers, Silver Squeeze, 1979-1980. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires who looked at silver in 1973 and saw the same thing I see today, a commodity with industrial demand, monetary properties, and a paper market far larger than physical supply. They started accumulating in 1973 when silver was $2.90. By 1979, they controlled approximately 100 million ounces of physical silver plus 90 million ounces in futures contracts. That's roughly 1 to 3 of annual global production. Here's the key detail. They took delivery. Most futures traders closed positions for cash. The Hunts demanded metal. Every month, more silver moved from COMEX vaults into private Hunt storage. The price response was explosive. January 1979, $6. September 1979, $10. December 1979, $30. January 17th, 1980, $49.45. That's a 724% increase in 12 months. But here's what matters for our current situation. The spike wasn't driven by new demand. It was driven by the revelation that physical supply couldn't cover existing paper claims. When the hunts demanded delivery, COMEX vaults emptied. Other traders panicked and demanded delivery too. The paper market broke. COMEX's response, they changed the rules. On January 7, 1980, they implemented Silver Rule 7, which prohibited new long positions. You could sell, but you couldn't buy. Then they raised margin requirements from 10% to 100%, forcing traders to deposit the full contract value in cash. The hunts couldn't meet the margin calls. They sold. The price collapsed from $21 to $10 on March 27, 1980. Silver Thursday. The hunts went bankrupt, but notice what happened. The people holding physical silver survived. When the dust settled, silver was still 66% higher than where it started. The paper traders got destroyed. The physical holders kept their wealth. That lesson matters because we're in a similar setup, except this time it's not two billionaires demanding delivery. It's industrial users, sovereign nations, and institutional investors across dozens of countries. COMEX can't change the rules on everyone simultaneously. Palladium shortage, 1997 to 2001. Palladium is a platinum group metal used in catalytic converters. In the late 1990s, Russia controlled 60% of global supply. Most of it came from Soviet-era stockpiles that Russia had been selling since 1991. In 1997, palladium traded at $120 per ounce. Industrial users, primarily auto manufacturers, didn't worry about supply because Russia had been a reliable seller for years. Then in 1998, Russia announced delayed shipments. No explanation, no timeline, just delays. Prices jumped to $180. Auto manufacturers got nervous. They started building inventory, buying more than they needed immediately just to secure future supply. Russia's delays continued through 1999. Prices hit $350. Now the paper market started panicking. Lease rates, the interest rate to borrow palladium, spiked to 30% annualized. That's not normal. That's desperation. By January 2001, palladium hit $1,094 per ounce. It had increased 812% in 4 years. Automakers paid whatever price was necessary because without palladium, they couldn't build cars. The cost of the metal was tiny compared to the cost of shutting down production lines. The squeeze broke when automakers substituted platinum for palladium in catalytic converters. It cost billions to re-engineer, and platinum was less efficient, but they had no choice. By 2003, palladium had crashed back to $180. Key lesson. When industrial users need a commodity and physical supply disappears, price becomes inelastic. They pay whatever is necessary, and that demand can push prices to levels that seem irrational, until you understand the alternative is production shutdown. Rhodium crisis, 2019-2021. Rhodium is another platinum group metal, primarily used in catalytic converters. In January 2019, it traded at $2,000 per ounce. By March 2021, it hit $29,800, a 1,390% increase in 26 months. What happened? Production collapsed. South Africa, which produces 80% of global rhodium, faced mining strikes, electricity blackouts, and COVID lockdowns. Supply dropped by 15% while emissions regulations increased demand. But here's the important detail. The price didn't rise gradually. It moved in violent spikes. In July 2020, rhodium was $8,000. By September 2020, it was $14,000. That's a 75% move in 2 months. Then it stabilized for 3 months before spiking again to $22,000 in January 2021. Why the spikes? Because physical shortage doesn't create smooth price discovery, it creates panic hoarding. When users realize supply is constrained, they buy aggressively to secure material. That buying pushes the price higher, which triggers more panic buying, which pushes it higher still. It's a feedback loop. Rhodium eventually crashed when Chinese refiners flooded the market with recycled material and automakers reduced rhodium content per vehicle. But for 18 months, anyone who needed rhodium paid extortionate prices because the alternative was worse. Pattern recognition. All 3 examples share characteristics. Paper market much larger than physical supply. Industrial users dependent on the commodity. Sudden recognition of physical shortage. Panic buying by entities who need the material. Parabolic price spike as paper market breaks. Eventual resolution through substitution or new supply. Silver is following the exact same pattern. The 5-day $10 move is the sudden recognition phase. What comes next is panic buying. And unlike rhodium or palladium, silver has no substitute for most applications. Modern data, layer. Now let me show you the data that convinced me we're entering the panic phase. COMEX vault drainage. As of December 23, 2024, COMEX registered silver stands at approximately 20 million ounces. This is down from 80 million ounces in October 2024. That's a 75% decline in registered inventory in just over 2 months, but the speed is accelerating. In the first week of December, 2.1 million ounces left. In the second week, 3.7 million ounces. In the third week, the week of the $10 spike, 8.3 million ounces vanished in a single withdrawal by JP Morgan. This is not normal profit taking. This is a bank run. When withdrawals accelerate as price rises, it signals that holders don't believe the paper price reflects physical scarcity. They're pulling metal out because they think it's worth more than the market shows. At the current drainage rate, COMEX registered silver hits zero in approximately 6 to 8 weeks. What happens then? Either COMEX changes delivery rules, like they did in 1980, or futures contracts start failing to deliver. Both scenarios are massively bullish for physical holders. Shanghai Premium. The Shanghai Gold Exchange operates differently than COMEX. It's a physical delivery market. When you buy, you get metal, not a promise. The Shanghai Premium is the difference between Shanghai's physical price and COMEX's paper price. Normally, this premium is $0.10, $0.30 per ounce, reflecting transportation costs and local demand. On December 22nd, it hit $3.50. That means Chinese buyers were paying $46.30 for silver, while COMEX showed $42.80. Why would anyone pay a $3.50 premium? Because they don't trust COMEX delivery. They want guaranteed physical metal, and they're willing to pay extra for certainty. This is the exact pattern we saw in March 2020. When COVID hit, the Shanghai premium spiked to $4 as Chinese buyers hoarded physical silver. COMEX price dropped to $12, but you couldn't buy physical silver anywhere for less than $18, $20. The paper and physical markets completely decoupled. We're seeing the same decoupling now. And historically, when this happens, the physical price always wins. The paper price eventually rises to meet physical reality. Refinery suspensions. The suspension of retail orders by PAMP, Heraeus, and Valcambi is unprecedented in my experience. These are the 3 largest precious metals refineries in the world. They supply most of the silver bars and coins to dealers globally. Why would they suspend orders during a price spike? Shouldn't high prices bring more supply to market? Here's what I think happened. These refineries operate on a hedging model. When they buy raw silver to refine, they simultaneously short the futures market to lock in their profit margin. This protects them from price fluctuations during the refining process, but when price moves $10 in 5 days, their hedges blow up. They're short futures at $35 and the price is now $43. Their hedges are losing millions per day. They can't buy more raw silver because they can't afford to hedge at current volatility levels. So they shut down retail operations, they stop accepting new orders because they can't manage the risk. This removes thousands of ounces per day from the retail market, which tightens supply further, which drives the price higher, which makes hedging even more impossible. It's a death spiral for the paper market, and it means physical silver is about to become extremely difficult to source. Industrial Stockpiling Bloomberg reported on December 20th that 3 major solar panel manufacturers, LONGi Green Energy, JA Solar, and Trina Solar, have increased silver procurement budgets by 40% for Q1 2025. This isn't about increased production. This is about securing supply before it disappears. Solar panels use silver paste for conductivity. There's no substitute that maintains efficiency at scale. The solar industry consumes roughly 140 million ounces per year, about 15% of total annual supply. When solar manufacturers start panic buying, they're not price sensitive. If silver goes to $50 or $60, the cost increase per panel is $3 to $5. But if they can't get silver at all, the production line stops. A $50 billion company isn't going to let production halt over a $5 per panel cost increase. This is the industrial bid entering the market, and industrial buyers don't trade. They accumulate and hold. Every ounce they buy is removed from available supply permanently until the panels are recycled in 25 years. ETF Flow's SLV, the largest silver ETF, saw inflows of 18.3 million ounces in the week ending December 20th. That's the largest weekly inflow since February 2021 during the Wall Street Bets silver squeeze. But here's the difference. In 2021, it was retail momentum. This time, it's institutional. The inflows are coming in blocks of 500,000 plus ounces. That's not retail investors. That's funds, pensions, and family offices. When institutions enter, they don't day trade. They allocate and hold for months or years. This represents a permanent bid under the market. Open interest versus inventory. COMEX silver open interest, total outstanding futures contracts, represents approximately 650 million ounces. Registered inventory is 20 million ounces. That's a ratio of 32.5 to 1. Historically, when this ratio exceeds 20.1, delivery problems begin. When it exceeds 30.1, the paper market breaks. We're at 32.5.1 and accelerating. In 1980, the ratio hit 40.1 before COMEX changed the rules. In 2011, it hit 35.1 before prices spiked to $49. We're in the danger zone right now. The hidden mechanism. Here's what most people don't understand about the silver market. The price isn't set by supply and demand for physical metal, it's set by supply and demand for futures contracts. When a bank wants to suppress the silver price, they don't sell physical silver. They sell futures contracts, promises to deliver silver in the future. These contracts trade on COMEX, just like physical metal, so they affect the price the same way. But here's the trick. The bank doesn't need to own the silver to sell the contract. They just need margin, typically 10% of the contract value in cash. So with $1 million, a bank can sell contracts representing $10 million worth of silver. This is called naked shorting. When banks flood the market with naked shorts, it creates selling pressure that drives the price down. Retail investors see the price dropping and sell their holdings. Industrial users delay purchases. The price drops further. The bank profits from their short positions. This mechanism has kept silver suppressed for decades, but it only works if nobody demands physical delivery. As long as traders close contracts for cash, the bank never has to produce the actual metal. The 5-day spike tells me this mechanism is breaking. Here's why. When price moves $10 in 5 days, short sellers face massive margin calls. If a bank is short 10 million ounces at $33 and the price hits $43, they're losing $100 million. The exchange demands they post additional margin, cash to cover the loss. If they can't post margin, the exchange liquidates their position, forces them to buy contracts to close the short. That buying pushes the price higher, which triggers more margin calls on other shorts, which triggers more forced buying. This is called a short squeeze. The vault drainage suggests major shorts are delivering physical silver to close positions rather than buying futures contracts. Why? Because buying futures would push the price even higher. It's cheaper to deliver metal, if you have it. But JP Morgan's 8.3 million ounce withdrawal suggests they're running out of metal to deliver. If the largest player in the silver market is emptying vaults, it means they're either closing shorts or securing supply for clients who are demanding physical delivery. Either way, it means the paper market is losing control. And when paper loses control, physical scarcity sets the price. Eruption scenario based on historical patterns and current data. Here's how I see the next 6 to 12 months unfolding. Phase 1. The consolidation, January-February 2025. Silver consolidates between $40–48. The media calls the $10 spike a speculative bubble. Mainstream analysts say silver will return to $30. Retail investors who bought at $42 panic and sell. But underneath, the fundamentals tighten. COMEX registered inventory continues draining, 1 to 2 million ounces per week. Industrial buyers continue stockpiling. ETF inflows continue. The Shanghai premium remains elevated. This consolidation phase is the last chance to accumulate before the next leg up. It's what happened in 1979. Silver consolidated at $10 for 3 months before spiking to $30, and in 2010, silver consolidated at $20 for 4 months before running to $49. Phase 2, the recognition, March-May 2025. A catalyst triggers broader recognition of the shortage. Possible catalysts. A major dealer, like APMEX or JM Bullion, suspends silver sales, COMEX changes delivery rules, or raises margins dramatically. A solar manufacturer publicly states they're struggling to source silver. A central bank announces silver purchases for reserves. When recognition hits, price gaps from $48 to $60–65 in a matter of days. This isn't gradual appreciation, it's a panic-driven repricing, as the market realizes physical silver is genuinely scarce. Premiums explode. Physical silver eagles that were $3 over spot are now $10–15 over spot. Online dealers show out of stock across most products. Lead times extend to 8 to 12 weeks. Phase 3, the mania, June–September 2025. Media coverage intensifies. Silver makes CNBC and Bloomberg front page. Retail investors who ignored the $40 spike start buying at $70. Investment demand compounds industrial demand. Pension funds and family offices allocate 2 and 5% of portfolios to physical silver as an inflation hedge. This represents hundreds of millions of ounces of demand from entities that weren't previously in the market. Short sellers face catastrophic losses. Small funds go bankrupt. Larger institutions beg regulators for intervention. COMEX implements emergency measures, position limits, forced liquidation, or cash settlement of contracts. These measures don't stop the rally. They accelerate it because they prove to the market that physical delivery is impossible. Every rule change is an admission that the paper market was a fraud. Price hits $100 per ounce. The gold to silver ratio, which has been 80.1 for years, drops to 40.1. Silver outperforms gold by 3.1. Phase 4, the peak, Q4 2025 or Q1 2026, silver peaks somewhere between $100 to $150 per ounce. The exact level depends on how aggressively central banks intervene and whether substitution becomes possible. At 100 plus, several things happen. Solar manufacturers reduce silver content per panel, thrifting, jewelry demand collapses, price destruction, recycling surges as people sell old silver, mining production increases, but this takes 18-24 months to materialize. These factors eventually cap the price, but the peak could last for months. In 1980, silver stayed above $40 for 3 months. In 2011, it stayed above $40 for 4 months. Phase 5, the correction, 2026. Eventually, price corrects. Maybe it falls to $65, $70, maybe $50. The exact level depends on whether new supply comes online and how much speculative leverage gets liquidated. But here's the key. The correction happens from 100 plus, not from $42. Even if silver falls 50% from the peak, it's still at $50, $75. Anyone who bought physical at $30, $40 is still profitable. The people who get destroyed are the ones who buy at $95 with leverage, or who hold paper contracts that get cash settled against their will. Timeline summary, January, February 2025. Consolidation at $40 to $48 March, May 2025. Breakout to $60, $70 June, September 2025. Mania phase to $85, $100 Q4 2025 to Q1 2026. Peak at $100, $150 2026. Correction to $50, $75. This timeline could compress or extend based on geopolitical events, Fed policy, or black swan events. But the direction is set. The 5-day $10 move was the starting gun. The warning. I need to be very clear about what I'm saying and what I'm not saying. I'm not giving financial advice. I'm not telling you to buy silver. I'm analyzing a pattern that has played out multiple times in commodity markets and explaining why current data suggests we're early in that pattern. I'm not saying this is guaranteed. Markets can remain irrational. Governments can intervene. New supply sources can appear. Technology can create substitutes. Black swans can change everything. But I am saying this. The combination of signals we're seeing right now, explosive price movement, vault drainage, physical premiums, refinery suspensions, and industrial stockpiling, has historically preceded parabolic moves, and those moves don't happen over years. They happen over months. If you're going to position for this, here's what I think matters. Physical over paper. If the thesis is correct, that paper markets are breaking, then holding paper silver, ETFs, futures, mining stocks, is counterproductive. Physical metal in your possession is the only position that benefits fully from a shortage. Timing matters less than positioning. Trying to catch the exact bottom is impossible. If silver goes to $100, it doesn't matter whether you bought at $35 or $45. What matters is that you bought before the mania phase. Premiums are the tell. Watch physical premiums, not paper price. If spot is $45, but dealers are charging $60 for silver eagles, the real price is $60. The paper market is lying. Position sizing is critical. This is a volatile, speculative trade. Don't bet money you need for living expenses. Don't use leverage. Don't convince yourself it's safe because it's a physical commodity. Silver can drop 50% in a month. It's done it before. Exit strategy is essential. If silver hits $100, what's your plan? Are you selling for dollars, swapping for gold, holding for $150, trading for real estate? Know your exit before you enter. Here's what keeps me up at night. The 5-day move happened faster than any comparable move in modern history. That suggests the mechanism that normally keeps price contained has completely failed. When mechanisms fail, price discovery happens violently. The Hunt brothers had months to accumulate before the spike. We may have weeks. The palladium squeeze gave years of warning signs. This is giving days. I could be wrong. Maybe the $10 move was a one-time event. Maybe paper markets regain control. Maybe new supply floods in. Maybe industrial demand softens. But if I'm right, if we're in the early stage of a supply-driven mania, then the window to position at reasonable prices is closing rapidly. The question I keep asking myself, 5 years from now, when silver is either $25 or $200, will I regret acting on this pattern or ignoring it? The businessman in 1929 who withdrew his savings was called paranoid until the banks closed. The investors who bought palladium at $300 were called crazy until it hit $1,000. The people who recognized the pattern early weren't lucky. They were prepared. So here's my final question. Do you see what I see? Do you see the vault drainage accelerating, the premiums expanding, the refineries shutting down, and the price compressing months of movement into days? And if you see it, what are you going to do about it? Because if the pattern holds, and it's held for 50 years across multiple commodities, the panic phase is just beginning. The entities pulling metal out of COMEX vaults know something. The refineries suspending orders know something. The industrial buyers stockpiling know something. The question is, do you know it too? Or will you realize it when silver is $85 and physical premiums are $30 over spot and dealers have 12-week lead times? The 5 days that changed everything just happened. The next 180 days will determine who saw it coming and who realized too late.